So hello everyone, and I hope everyone is doing well. And I just want to call your attention to table 1.1 here in chapter 1, and it's an excellent table. And they talk about the three basic forms of business organizations, and the strengths and the weaknesses. And as you can see, there's a sole proprietorship, a partnership, and a corporation. And they go over some of the strengths and weaknesses here. And obviously, if someone owns a small business like a pizzeria, or they have their own little store, right, a coffee shop or something, they receive all the profits, but then they they get all the losses, right? And it's easy to to start this business. And basically, anything you make is going to be on your personal tax return. And a lot of people like the independence, right? And the secrecy of having their own business. They don't have to have anybody to, disagree with. And partnerships can raise more money, right? Partnerships have the chance of raising money through banks because they probably have a better credit rating, or venture capitalists or angel investors. And there may be more, and if there's more owners, if there's more than one owner, obviously, they got a lot more brain power, and there's a lot more cash available where they can borrow money. But again, everything's taxed on their personal tax returns. You see, for a sole proprietorship and a partnership, everything goes on their personal tax returns here. Okay. Now, for a corporation, right, the owners are the shareholders. Everyone should know that, right? The owner is the shareholder. That's you and me, right? As long as it's not private, but even if it's private, there are private investors, right? Private shareholders. And most of the owners have limited liability unless they're, unless there's some kind of, it's their own corporation. So if you're an investor, most you're ever going to lose is the value of your stock, like the people with Enron did. Remember Enron? And these get really, really large, the more shares. Like you see what's going on now with Apple and Tesla. They're splitting shares. So more people will be trying to buy in, and they'll maybe issue another IPO if they have to raise money. And ownership being transferable means what? That you sell your stocks and someone else buys them. And you could do that online, right? With Fidelity or TD Ameritrade or Schwab. Okay. And obviously, they have lines of credit where they can get better financing and either issue bonds or issue more IPOs for stocks or bonds, all right? And here's the weaknesses, right? So the owner has unlimited liability, and unless they have good insurance, they can be taken, wealth can be taken away to satisfy debts. A lot of people are losing their businesses now because of the pandemic virus, right? They're shut down. And, they may not be able to raise more funds depending on their income. And a lot of times it's hard to hire people who want, careers, which these days are hard to come by, right? And obviously this could be passed on to your children. So this bottom line isn't totally true here. All right. So... And basically, the owner, there's two types of partnership. There's owners who put their money in. They have limited liability. There's limited partners and basically general partners. And the general partners have unlimited liability. And they may have to cover the debts of other partners. And now, this ain't true also. The partnership is not dissolved when a partner dies. It could be, willed over. And it's really not that difficult to transfer these partnerships, as they say. So getting back, so now with regards to corporations, taxes are, it says generally higher because corporate income is taxed. But, a lot of times the presidents and Congress will fool around with the corporate tax rate, which you saw they just did. And I believe it's 22% now, right? The other thing is dividends paid to the owners are taxed, And also you pay tax on the dividends too, okay? So there's a thing called double taxation penalty where you pay taxes and the corporation pays taxes. And this is not necessarily true that it's more expensive. You could form what's called a limited liability corporation online, and I think it costs you about $150 to make or something. And I don't know if any of you ever formed it, but it's real simple to do now. And I guess as far as large corporations, they're subject to government regulation and all the rules that went on after the accounting scandals and the subprime mortgage crisis. And this is not necessarily true either. A lot of companies have hidden agendas, and they don't totally lack secrecy, even though they have price discovery. There's a lot of things that they don't have to tell you. So this is interesting here. So here's the number of firms that are sole proprietorships. A lot of people like having their own businesses, and here's the partnerships. And you'll know it's interesting that there's 25 million sole proprietorships as compared to partnerships and corporations. So this is the you can see that it's the percentage of all firms. But look at the business income. The percentage of business income is larger for corporations, obviously. Okay, so you can see all that. So how do corporations raise money? And you can see some of the points here. Stockholders will either buy stocks or sell bonds, right? Companies like selling bonds, okay, because there's no voting involved. And the shareholders and the bondholders have very limited liability. And when we go deeper into these chapters, we'll have more specifics about bonds. There's a whole separate chapter on stocks and bonds. Now, not all shares or not all stocks pay dividends. It says stockholders expect to earn a return by receiving dividends. And again, we'll talk about that. And dividends occur every quarter. And I have a lot of stocks that pay dividends. And my dividends are turned into more shares of stock. I don't get a check in the mail. I'll just get more shares of stock. Okay. Now, as far as shareholders go, they're the last to get paid if the company goes belly up. If the company has problems, the bondholders will get paid first, and then the credit holders and the preferred stockholders, and then the shareholders will get paid last. The common stock shareholders, so they get paid last. So they bear the largest risk, so they have to get the largest return, and that's usually reflected in the dividend, the amount of dividends, the percentage on the yield on the dividends. Okay, so here's the current tax rate. Now this, I believe, is for 2018, so this is kind of old. Okay, so you can see these rates have changed. This is for single taxpayers, okay? And I don't know if this is still up to date for single taxpayers here. And I think there's a corporate, and there's a nice example here on how much you would pay as a single taxpayer. And you'll notice here there's two numbers. There's the marginal tax rate, which is this percentage is the marginal rate. Okay, so this is called the marginal tax rate on any dollar you earn over 38,700 in this case, or one of these numbers here. But here's a nice example that shows you the total taxes due. Okay. And basically the total taxes due divided by your income would basically give you your average tax rate. So you can see here's your marginal rate in taxes above 38,700. And there's a nice video here, and you should watch these videos, okay? You should watch these videos, and they're really interesting.
Unlike corporations who face a flat 21% federal income tax, pass-through businesses such as proprietorships and partnerships are subject to the progressive individual tax rates. This pass-through taxation simply means that the individual owners of a business taxes on income derived from the business on their personal income tax returns. For individuals, income tax rates are progressive, meaning that the marginal tax rate rises with income. In this example, Dan Webster is the sole proprietor of Webster Manufacturing, which earned a pre-tax profit of $80,000. Assuming that Dan has no other personal income, he will pay a marginal tax rate of 10% on the first $9,525 in business income. On the marginal income from $9,526 to $38,700, he will pay a marginal tax rate of 12%. Finally, on the remaining income from $38,701 to $80,000, he will pay a marginal tax rate of 22%. Putting this all together, Dan Webster has to pay taxes of $953 on the first $9,525 of earnings, $3,501 in taxes on the next $29,175 of income, and then $9,086 in taxes on the last $41,300 of marginal income. In total, Webster Manufacturing earned $80,000 in income, and its owner has to pay $13,540 in taxes. To calculate the average tax rate for Webster Manufacturing's income, simply divide the total taxes paid by the total pass-through income. In this case, $13,540 divided by $80,000 is an average tax rate of 16.9%. However, the marginal tax rate is 22%. In other words, if Webster Manufacturing earns $1 more of income, Dan Webster will have to pay an additional 22 cents in personal income taxes. If rather than operating as a sole proprietor, Dan Webster had chosen to incorporate his business, then the corporation, and not Dan, would have to pay taxes on the business income. Starting in 2018, because of the Tax Cuts and Jobs Act of 2017, the U.S. corporate tax rate is a flat 21%, meaning that every dollar of a corporation's income is subject to the same tax rate. Under the corporate business form, Webster Manufacturing will pay 21% on every dollar of income, so the tax bill on $80,000 would be $16,800. Although this total is more than what Dan Webster pays on $80,000 under the progressive individual tax plan, consider the fact that under the corporate tax plan, the average and marginal tax rates are both equal to the flat tax rate of 21%. So the marginal benefit of earning additional dollars of income is much higher under the corporate tax plan. However, if taxes were Dan's only concern when deciding what form of business organization to use, he would also want to consider the impact of double taxation on the after-tax income received by owners in a corporation.